Hey everybody, welcome to this very special, very timely episode of The Complete Advisor. We are going to dive right into the big, beautiful bill. It is what everybody's talking about. Before I introduce Becky properly, what I do want to remind everybody is the episode before this of The Complete Advisor, we had Becky's partner in crime, Neil Wilding, on. And what he did, though, is we went through on that episode, potential TCJA, the changes, but also the landscape, especially as it relates to Roth, especially as it relates to IRMAA. That is a companion piece to this episode today. So you do totally, and I'll link this one back, but you need to go back to the episode prior. So what we're going to dive into today, we're going to take a look at what is in the big, beautiful bill and what it means to advisors. There's a couple provisions that we're going to hit on that Becky's really going to drive us down the path of key ones. And then I do want to ask Becky a couple questions about some of those other ones that I feel like are going to get advisors are going to get asked about, but they're really not as big of a deal. They don't apply to everybody, but there's going to be curiosity questions there. So knowledge is power. You got to have these things. So that being said, let me introduce to you special friend of the podcast, Becky Ruby Swansburg. Becky is the CEO of Stonewood Financial. She is truly a Washington insider. When I say that, it's because she worked in Washington, worked with the first Bush presidency. Right?
Second Bush, W.
Second, doggone. So the second Bush presidency. So expert when it comes to taxation. We have a great relationship with Stonewood Financial, and I love the support and services that you provide and training for advisors. Now, with that being said, Becky, of course, welcome.
Thank you so much for having me.
It is always good to have you on here. Let's just get right into the big, beautiful bill from 15,000 feet. Your take.
Yeah, if you had told me 18 to 24 months ago that we would be standing here summer 2025 with this massive package passed and signed into law of, keeping taxes lower for the American people, I would have probably told you there's a pretty slim chance of that. But we have somehow managed to just thread this needle. And I think the biggest takeaway from the One Big Beautiful Bill is that as financial advisors, as we are trying to help our clients plan into kind of an unknown tax environment of the future, This bill really is giving us more runway to develop and execute some of these plans. So we know that when you look across America at savers, most are very overweighted towards tax-deferred vehicles. 401ks, IRAs, very popular. But of course, if the majority or all even of your retirement assets are in these tax-deferred vehicles, you just don't have any hedge if taxes go up in the future. So I know a lot of the advisors listening today have really spent time over the past few years helping clients understand this risk of rising taxes and starting to prepare for it. One Big Beautiful Bill gives us a lot more runway to do some planning and get our clients in a better spot when it comes to future taxes in retirement.
Now so one thing you said there that I really want to echo on is, and this was a question my wife had asked me when I was telling her about the recording that you and I were going to do. And we did for those of you that don't know, we did a national webinar yesterday on this topic, or maybe 2 days ago. Yeah. But she said, well, how do you avoid getting political on something like this? And I said, our job as advisors when it comes to this, we never really get into, I feel personally like we never should, because our job is not, it doesn't matter who's in office at the moment, it's what they're doing. And like I've learned through our conversations, is tax law changes all the time. And you make an amazing point. I'll let you make it, but you say it's not a 4-year cycle. It's really
it's a 2-year cycle. So it's funny. The one constant in Washington is change. And a lot of people think the thing that is driving whether taxes will be higher or lower in the future is kind of are Republicans or Democrats controlling the White House and Congress. And that has some impact that can accelerate or slow the rise of taxes. But the thing that really is driving this instability, this unknown future, is the fact that in America, every 2 years we have elections. And that means every 2 years we have new government. So as we get into a lot of these provisions and the one big beautiful bill, part of the excitement is a lot of the provisions that were passed during the Tax Cuts and Jobs Act in 2017 have now been made permanent. But of course, that is permanent with air quotes around it because nothing in Washington is ever permanent. Every 2 years, we have new government. That means every 2 years, we have different leadership with different priorities and everything can change. So the real gift that we give our clients is not preparing them for Republicans or Democrats and what their policies might be. It's safeguarding their retirement approach from the inevitable back and forth of change in Washington.
Yeah, absolutely. So let's talk. One of the things in the bill is, for those, if you hadn't had a good look at it, there's some great articles and resources out there, but you definitely need to look at it because some of the provisions are permanent. And you know what? I'm going to look at the camera again because I was looking at my notes. I'm doing air quotes. Becky can't see me on this broadcast today with the way we're recording, but I'm putting air quotes around permanent or maybe an asterisk because there's always something. It's permanent, but, and then there's things that are temporary. Are there any big surprises before we break down the bill? Anything that really surprised you besides it being passed?
Yeah, it being passed. I think the biggest, and not really surprise, but the biggest planning opportunity for us as advisors is just understanding that with some of these temporary new deductions that we'll get into and a close to the lower tax bracket rate, the way that we convert money from tax deferred vehicles to tax-free vehicles like Roths is going to change. This bill has not in any way, I think, changed the need for conversions, but I do think it's going to impact conversion patterns. And so we have a very unique mix of temporary, so-called permanent, and how do we help make sense of all that for our clients? I think that's what we're going to get into today.
Yeah, the thing with these, so the one thing that I would be concerned about as I'm looking at my notes here is, the biggest one that everyone I think is probably going to be talking about is like, holy smokes, individual tax rates, standard deductions, that's permanent. So what I worry about, a lot of people thinking is like, so what's the rush then? The urgency on Roth is gone. When I worry about that complacency. What do you think?
I would like to preach on this for a little bit. I actually have a lot of thoughts on this because it is probably the number one question that I've gotten from both clients and advisors is like, look, for years we've been telling people taxes are going up. Now Congress has voted to keep them low permanently. Are we just crying wolf? Do we really need to worry about rising taxes? And what I like to tell people is, look, if you only plan to be retired for the next 4 to 8 years, don't worry about it.
Yeah.
We have a pretty good indication for the next 4 to 8 years where taxes are going to be. If, however, you are someone that would like to be retired 10, 20, 30, or even 40 years into the future, we can't just look at today's tax bracket rate environment. We have to look long-term at where rates are going. And it's interesting, look, I'm a bit of a presidential and policy geek. If you go and look at eras of low taxes in modern history, so let's go back to Reagan in the 80s. When we, under Reagan and under Bush 1, and then even Obama, who extended some of Bush's tax cuts, when we look at these eras of low tax bracket rates, they tend to last between about 8 to 12 years before tax rates rise again or normalize, either through expiration or through Congress just passing a law to rise the taxes. So the reason that I think long-term, most of our clients still need to be very concerned about rising taxes are threefold. Number one, tax bracket rates today are about 30% lower for kind of middle-class Americans than they were pre-reform back in 2016 before the Tax Cuts and Jobs Act. That means that we're actually about 30% off of more historical tax bracket norms. So we are actually in a very low tax bracket rate environment today. Of course, that means there's really only one place for taxes to go, and that is up. And when I think politicians get into office and they're looking to raise revenue and raise taxes, the people that they tend to depend on to generate that new tax revenue are, of course, higher income, higher net worth Americans, which are so many of the clients that we serve. Our clients may not think they're rich, but compared to everyone in America, Washington says there's a good opportunity for some new revenue. The final and I think most important reason I believe we are still over the next 10, 15 to 20 years in a rising tax environment is because of three key indicators that I tend to track that put pressure on the government to raise taxes. And those indicators are first and foremost U.S. spending. Do we currently generate enough revenue to pay for the government that we have today? Yeah. And the answer right now is no. In the last fiscal year, we took in about $4.9 trillion of revenue as a nation. And on mandatory spending alone, things Congress does not control. This is just things like Medicare, Medicaid, Social Security, and interest on the debt. We actually spent $4.9 trillion. So we spent 100% of the revenue our nation generated before Congress passed a single bill, before the president had a single priority, before we allocated any money for things like defense, military spending, transportation, infrastructure. So we're running about $1.5 to $2 trillion of deficit a year. So one, we're not even currently generating enough revenue to pay for current government. Two, the second indicator, what are future government needs? Well, that's really a question of demographics. And we have this rapidly aging U.S. population where in the years ahead, many, many more Americans are going to be relying on Social Security and Medicare. And by the way, Social Security and Medicare make up the largest single spending portion of our federal budget. So we know that by 2034, in about 10 years, Social Security will only have enough money to pay out 75% of the benefits. And we know that Medicare is growing at about 8% a year, compounded year after year after year. So when we look at the demographics, we know that somehow the government is going to need more money in the future to account for those demographic changes. The third indicator I keep my eye on is what I call debts and deficits. So in the last fiscal year, of course, we ran about a $1.9 trillion deficit, means we spent about $2 trillion more than we generated as a country. That, of course, is part of what is driving our federal debt to about $36.2 trillion, as high as it has ever been at any point in history by far. And there's this third debt, which is over the next 75 years, the Medicare and Social Security programs are about $75 trillion more expensive than we can project revenue covering. So when I look at these three indicators, it's not so much Republicans or Democrats being in control of Washington. There are a lot of economic, demographic, and debt pressures that are simply going to require our country to need more revenue. So a certain administration or a certain Congress might accelerate or slow the rate of rising taxes, but it cannot eliminate the need for more tax revenue. At this point, it's a math and demographics problem more than it's really a political problem. So I really want us to keep our eyes on the fact that the long-term outlook for taxes has not changed. But that doesn't mean we can't be excited about one big, beautiful bill, because it has given us this great gift of a longer runway to plan and prepare.
I love everything you're saying. And as you're talking and I'm thinking about, the numbers that, when we're talking trillions, it's almost, it's so hard to comprehend numbers that are that big. And as you were talking, I was thinking about something that Neil said on the last episode. Folks, literally, you do need to check out the episode that we did with Neil, where we talked about IRMAA, where we talked about Roth conversions. So a little more tactical. One of the things that I learned from Neil last episode was talking about IRMAA and the fact that it was a fee, right? Yeah. And so as you were talking, I couldn't help but think like, these tax rates and these deductions have been made permanent, but we're just talking about these. And if there's one thing Congress and politicians they're pretty doggone clever, which then made me think about IRMAA and the fact that it's a fee, not a tax. Going a little off topic, do you have any feel as far as like what kind of creative things do we need to be prepared for?
Yeah, a lot of times advisors and our clients, we kind of use tax rates as a proxy for taxes. But they are only really one component of how our government can generate funds. So we've got the tax bracket rates, which are for now low. Another component is how much income is applicable to each rate. And in fact, during, I think Reagan's either first or second tax package, we saw when they lowered the top tax bracket, how they got support for that was saying, we'll lower the rate, but we will make vastly more Americans subject to that higher rate by reducing the amount of income that triggers it. So one is they could very easily come back and just make more of our income subject to higher tax bracket rates, even if those rates are low compared to in past years.
That's a great point. I think you said it one time. It was brilliant, and I'm crediting it to you. I believe you said it, but the levers, the government has so many levers that they can move around with.
Yeah, they've got levers. They've got kind of tools in their tool belt. So the two other tools we got to keep our eyes on, one are deductions, and we'll get in just a minute. I really want to spend some time on these new deductions for seniors age 65 plus, because I think that's where you're going to find a lot of client questions. And I'm even hearing a lot of advisor questions around that. So deductions, obviously, if you can deduct less money, you're paying taxes on a larger amount of income.
All right, let's as we go into these, I'm going to change it up. I want to rattle you a little bit.
Let's do it.
I'll throw it out there, and here's what I want you to do. I'll throw the provision, and you say if it's a big deal or not, and then how we can what's the takeaway? Okay. Yeah. So you just mentioned the enhanced additional deduction for seniors. Big deal or not?
Huge deal for two reasons. One, a big benefit for seniors, but two, a temporary benefit for seniors that is going to expire in a few years. So do you want to spend a second, Dennis, maybe getting into what happened around this new kind of Social Security offset?
Absolutely.
All right. So as we all know, the president campaigned on the idea that seniors should not have to pay taxes on their Social Security benefits. Social Security benefits were not originally taxable when the program was introduced. That taxation was introduced in the 80s and then reformed in the 90s. Now, because of how the Senate had to pass this bill, they could not simply go and remove the taxation of Social Security benefits. Unlike the rest of your income, the taxation of Social Security benefits doesn't actually just go into the big IRS pile. It is earmarked into the Social Security and Medicare trust funds. So they got creative, as Congress will do. And what they said instead is, okay, we're going to give all Americans age 65 plus the potential to have a new tax deduction. And we feel in kind of mental math that this tax deduction will be about equal to the taxes that you pay on your Social Security benefit. Now, what this new deduction is it is a deduction for anyone age 65 plus. You do not have to have elected Social Security to take this deduction, even though the president's kind of saying this deduction is intended to offset the taxation of Social Security benefits. So everyone age 65 plus. It is a $6,000 per individual deduction that seniors can take on top of their standard deduction. They can also take this deduction if they itemize instead of take the standard deduction. So this is just an extra $6,000 per individual, so $12,000 for a couple that they get on their taxes. Now, the full deduction is good up to about, if for an individual, $75,000 of modified adjusted gross income, taxable income, and for couples about $150,000. After that, it starts to slowly phase out, and the deduction is totally gone at about $175,000 of income for an individual and $250,000 for a couple. But that does mean a lot of our clients will either get the full or at least a partial deduction. Great news for seniors. However, this is a temporary provision that was not made permanent. It is only good for the 2025, 26, 27, and 28 tax years, which means in 4 years it goes away. That's one of the reasons that, Dennis, I was saying, the real impact of one big beautiful bill on Roth conversions is not should we or should we not be converting money. Long-term tax mitigation is still an important topic. We should still be helping people diversify into tax-free assets. The real impact of One Big Beautiful Bill is going to be the structure of those conversions. What is the pattern of how we convert money to ensure that not just long-term, but also during the conversion process, we are minimizing taxes, we are minimizing IRMAA, and we are maximizing these deductions, and we're not risking eating into these deductions by getting too much income in any one year. So we're seeing in the past maybe a 3-year conversion or a 5-year conversion. It might now make sense to convert those funds over 8 years or 10 years. And this is where I know we've plugged it, but you got to go watch my colleague Neil's podcast, because it is all about how do we analyze that conversion process.
Yep.
You know, it used to be pretty easy to convert funds. We'd just say, is it a good deal long-term on taxes? If the answer is yes, we can make a case for it. Today's advisors that are going to really differentiate themselves and grow their practice with these tax-free messages are going to be the advisors that understand One Big Beautiful Bill and understand how to structure that conversion process. And Dennis, you know, at Stonewood, we have this Roth Done Right software that we are updating, because I think the biggest benefit of software going forward is going to be modeling out different conversion patterns so our clients can see how to minimize taxes, IRMAA, and the loss of deductions.
I love it. You guys have done, you put together, we've had a great relationship with you, the company I work for. We had a great relationship with you guys. And you keep doing great things. Neil's episode, folks, don't forget to check that out. Okay, next big one. So big deal or not a big deal, and then also permanent or temporary, but lifetime gift and estate tax exclusion now is $30 million for couples. Big deal, not a big deal.
Yeah, big deal. And that's another one of the provisions that is permanent with the air quotes or asterisks. But that was set to expire at the end of the year, and those estate tax exemptions were going to be dramatically reduced. So when we have clients with family farms, just big businesses, big, estates that they will pass on, they can now start moving more of those funds. They have more time at this higher exemption. So big deal for the clients it impacts, and glad that it's permanent so that we at least have some runway going forward to get these done.
Very nice. Okay, big deal or not a big deal? The safety net cuts, Medicaid, SNAP, how's that affect advisors? Big deal or not a big deal?
Yeah, it'll be interesting. It'll affect our states quite a lot. I think the opportunity there for advisors, since most of our clients, by and large, are not Medicaid recipients unless they kind of have a special need for that. Really what I think this is doing is lending credit to the story that advisors have really been telling for some time now, which is, yes, we want to depend on government programs like Medicare, Medicaid, and Social Security, but we also need to make sure that we have a foundation on our own so that changes to those programs don't negatively impact your retirement. And this is where conversations about long-term care, whether through individual policies or through these kind of riders and benefits we can get in annuities and in life insurance policies, that's going to become important, because while a lot of our clients may not be impacted by the Medicaid cuts, certainly they sense that the government is kind of removing a benefit that it had given to states and to these populations, and then everything is fluid.
I like it. So now an opportunity for a conversation. Okay, next one. This is one that always throws me a little bit, but that SALT deduction cap was temporarily raised. Big deal, not a big deal. Who does that actually impact?
Man, a big deal if you live in New York or California. That is going to be a huge piece if you either located or serve clients in those high state tax environments. Yeah. And this is another reason whether you use Stonewood software or whatever Roth conversion analysis software you're using, make sure that it is modeling for all of these changes that have happened in One Big Beautiful Bill. Because as we're converting funds over, we also want to be mindful that we're not eating into how much of that SALT deduction our clients can take.
And that one's temporary, right?
That is temporary.
How long?
Here in Kentucky, not a big deal. We have very low state taxes, but for a lot of people that are listening, big deal.
Yeah, everyone yawned in Texas and Florida, right?
That's right.
Okay, let's go over we've hit the big ones, right? Like the big headline ones. Let's hit on some of these other ones and just give an idea here. Over in small business and for workers, I see the QBI deduction for business owners was made permanent. Big deal, not big deal?
Yeah, it'll be a big deal for some of our clients. And for a lot of these, I think kind of next tier, smaller or more specific deductions and tax changes. This is where if you have a CPA in your practice or you work closely with a CPA, these are the ones where really a lot is going to depend on the client's individual situation and a lot of other factors that go into it. So this could be a big deal. And I think these are ones that it is worth really consulting with tax experts, or if you're a tax expert yourself, because a lot of these kind of deductions and different credits have a lot to do with individuals. And there's a lot of different requirements and intricacies that we're not seeing in kind of these larger scale new deductions for seniors age 65 plus or lower tax bracket rates.
I think to piggyback what you just said, I think you need to take a look at your book and your client base and see, because if anybody's going to ask you about what the next couple ones we're going to hit on, they're very personal and you're going to need to know, because they're going to want to know. And they're not asking, if somebody's asking about these, they're going to be asking specifically because it applies to them and they're really curious.
And I will also say, keep in mind, if you're chat GPTing or clouding some of these topics in the legislation, some of the provisions, they are not just detailed in the provision, but the execution is detailed. In some of these provisions, they're actually waiting on the Treasury or on a different entity to kind of issue rules on how we will go about doing all of this. Yeah. So not everything will we know the answers immediately.
Yeah, I had a friend whose wife is a nurse. They were looking at, this totally exemplifies what you just said. After 10 years, there are some programs where nurses can have their student loans waived.
Yeah.
If they meet these criteria. And they thought it would just be like bang, bang, bang. But the criteria and the forms and going through the steps, like you're just saying, there's yes, you can do that, but then how do you do it is so doggone detailed.
As a reminder for everything that applies, the bill, one of the real wonderful things that Congress did was the provisions in this bill are applicable to the 2025 tax year. So they kind of modify what we are currently living. But as a reminder, government technically has until April of next year to publish all the details for how we file the 2025 tax year. So they do have, 3/4 of a year ahead of them to really work out all these details.
Yeah. Okay. Auto loan interest deduction is back, but with a twist. Big deal, not a big deal.
Yeah, it'll be a big deal for the people that it'll impact. It is not a huge amount of money, but certainly for your clients, especially that itemize and that like to take a lot of these deductions that they can find, it'll have an impact.
What is that? The twist is that the vehicle has to be made in America or something?
Yes. And, I always love that argument, because I drove for many years a Japanese Subaru, which was 100% manufactured in Indiana. And my husband at the time drove a good American Ford Ranger that, of course, was made in Texas, or made in Mexico. So they're going to have to work out how you qualify for what.
There are definitely some things. Let's see here. What else we got? Overtime and tip deduction. Yeah. I don't see that being a big deal for most people.
Not for a lot of our clients, but we may get some questions on it, especially if clients have children that are working and are impacted by, older children that are working and impacted by that.
What about, here's one I think that might be interesting. College endowments got a hit with some tax structure. And my understanding is maybe high net worth donors, we may have an opportunity there to adjust strategies. Can you get that one?
Yeah. And this is another one where we're, first of all, waiting for some additional clarification on how this will execute. This is one of those ones where I think it is sensitive or exposed to some future adjustment as well.
Yeah.
So that is definitely consult with a CPA because this is going to be a shifting area of rules being issued around it.
And that's always a good reminder. Unless you are a tax expert or a CPA or a tax attorney, you best be working with somebody to make sure you don't get out over your skis.
Yep.
There's 3 more that are on my list. I'm going to save the one that I think is interesting that I don't quite understand. So I'm excited to clarification.
Let's see.
Do you think the phase out on clean energy tax credits, you think that's going to stick? What do you think is going to happen there?
Yeah, it's interesting. I could make an argument that by making a lot of these tax cuts permanent, Congress has set us up to get some of them overturned sooner rather than later. If something is going to naturally expire in a few years, if we get a Democrat-controlled House, Senate, and White House, they might not mess with it because it's going to expire. But when we have things that are now permanently codified into law, the next administration, if it has a different point of view, has more incentive to kind of make campaign fulfillment out of overturning some of those things.
Yeah.
So I do think this will continue to be a place where we'll see credits put on, credits taken off, credits put on, credits taken off, particularly because a lot of the green energy tax credits benefit higher net worth Americans that can invest in these kind of greener opportunities.
Yeah. Well, that'll be interesting. Okay, there's 2 more. I take it back. I still have 3. The child tax credit. Can you talk about practical effect? And then also, I'm missing one here. Oh, the Trump accounts. Yeah,
the Trump accounts are interesting. Also only temporary. But I do think that this is all kind of, I put under a category of what are the ways that the government allows us to kind of defer taxes or avoid taxes in a current year on different priorities that it wants to incentivize. So incentivizing childbirth and having children, incentivizing college education with 529s. I do think we are going to see more and more of these kind of piecemeal credits or exemptions or different ways that we can save funds because they are relatively cheap to implement, but they get a lot of voter satisfaction. So the people that then get those accounts really feel like they have a benefit, but it's not as expensive as just raising everyone's tax rate by 1%.
Okay, the last one, I hadn't really seen this, but can you enlighten me? The remittance tax. Big deal, small deal? What kind of deal is that? This
is another one of the issues where the government has kind of issued their intention, but not their guidelines. So Dennis, I hate to say I'm about as confused on this one as you are. There's not a lot of details. It's funny, in most big packages, this is not unique to the One Big Beautiful Bill. We saw this with Obamacare and the Tax Cuts and Jobs Act and the Inflation Reduction Act. Congress passes the ideas and what they want to see, how they want to see the code change, the tax code change. But a lot of different government agencies have to take a hand into how do we implement that? What are the rules and how does it get executed? So I actually think right now, I've seen Social Security with comment, Treasury with comment, kind of saying we're working out the rules to implement all of this. And it's not a bad thing. I mean, we want to, devil's always in the details. We want to make sure that things are being implemented in a way that our clients can take advantage of them. So we will see there.
There we go.
Yeah. But it does. I will say one thing that I thought was a little bit missing from this bill that I do think we'll see more of in the future. We talked a little bit about IRMAA earlier on in the call. Mm-hmm. IRMAA, of course, is the income-related monthly adjustment amount, additional fee or tax surcharge that some Americans pay for their Medicare Part B and Part D benefits on top of their premium. So you pay your premium, and then based on your income from previous years, you might also pay this extra IRMAA tax or IRMAA fee. The 2 most important letters in IRMAA is that IR, that income related. We are seeing a trend where outside of tax brackets, our government is looking for more income related ways or ways based on your income level to generate additional fees and revenue. And one of the reasons that I think it is so important for us to keep our eye and for our clients to keep their eye on IRMAA is because the Medicare Part B and Part D trust funds are the only two major government trust funds expected to be financially sound over the next 10 years and beyond. That's it. Every other part of Medicare, the Social Security Trust Fund, everything else has these dire warnings. But Medicare Part B and Part D trust funds are okay. And the government has said they are okay only because the government can raise premiums and IRMAA fees as high as they need to offset future costs. So one, we need to keep our eye on IRMAA because it is rising and we want to help minimize that for our clients. And that's part of the long-term need for these Roth conversion strategies. Roth income is not calculated towards IRMAA brackets. So we have to help our clients shift some of their assets into tax-free vehicles, not just to avoid rising taxes, but to avoid rising IRMAA fees and other government fees that are going to be revenue generating, that are going to be tied to how much income you're reporting.
Yep. I have to tell you, you said the two most important letters in IRMAA. There's one that was a shocker. And so again, I'm gonna shamelessly plug that conversation with Neil. It was the episode right before this. But what I didn't realize, and I don't think most advisors realized, and I actually didn't realize it until you said what it stood for, the M being monthly, because I think most people think about IRMAA and they're like, oh, it's a couple $100, right? Like it could be in that. And you're thinking like, okay, well, we're talking a couple $100. And it's like, no, that's every month. It's not like an annual, it's monthly. And then the other thing that I learned from the conversation with Neil, which you just reiterated, is it isn't legislation that's passed to raise that fee. It's the agency. Like they're looking at it just like Ticketmaster raises the fees on tickets. It's that's just the way it is. And that's a big deal. And I feel my own 2 cents here, but I feel like just what you were saying a second ago, that government is going to be looking at more of those opportunities because we've got to pay for it. So, hey, great that we lock these rates in permanent, but there's all these other levers that can be pulled. And they have to be pulled because that deficit's just so doggone big.
And that's kind of, I think, the net of one big beautiful bill broadly as we are communicating with our clients.
Yep.
One big beautiful bill has not changed the need in our nation for higher taxes in the future. Mm-mm. What it has done is given us a longer runway to make adjustments to our flight plan to avoid those higher taxes in the future. Yeah. So this is an exciting bill. I don't want us to be doom and gloom and lose that excitement that our clients feel and should feel that their taxes will be lower for the coming years than they thought. But we have to leverage that low tax rate environment. It is not the end. It is a means to an end. And the end is mitigating long-term in retirement over the next 3 to 4 decades, these pressures that will slowly drive taxes and other government surcharges like IRMAA up for our clients, for the wealthier Americans who have done a good job saving and preparing for retirement.
Yeah, spot on. You know, it is one of those things. Our job as advisors is to advise and to look at the path before us and before our clients and help them make the best choices and protect their retirements. And but it is it is exciting too, because now all of a sudden, yes, what was out there before now has changed, and we have to adapt. And it creates the opportunity for a ton of awesome conversations to have with our clients and other people.
And I've said, the single thing that we can do as financial professionals when it comes to taxes and retirement is we can help our clients leverage the tax environment today to prepare for the potential tax environment of tomorrow. And one big beautiful bill has given us maybe a once or twice in a generation opportunity to really leverage the environment of today to prepare for the environment that's coming.
Man, I was just going to ask you for a final thought, and I don't think you could have said anything better than that. Becky, thank you so much for being on the show. Anytime. You are always welcome. Someday, for those of you that have, if you've seen some of our other conversations, We'll solve who was the best looking president. We'll solve that one of these days. We'll do brackets sometime. We'll do who's the
that would be a
president.
good hottest head of state bracket, and we'll see who wins.
That's hilarious. Okay, for Becky, thank you so much. For everybody else, thank you for joining us for this episode of The Complete Advisor. If you get a chance, I'm going to ask you for a favor, and that favor is this. If you get a chance, like, subscribe, follow the show. That way you are in the know whenever we put a new episode out there, bang, you get it. Also, though, here's part 2 of the favor. If there's a topic that you want me to explore, that you want to go on a conversation path with me, let me know. Drop it in the comments, shoot me a direct message, and we'll go and we'll find an advisor or an expert and have that conversation. And then lastly, if you've got any advice for me, any criticism, constructive or otherwise, I'd love to read it, send it my way. But with that being said, thank you so much for joining us. We'll see you next episode.